look at the effect or lack thereof that events in Egypt may have on markets around the world, and particularly the energy sector, which we just heard Adam talk about. We welcome Daniel McMahon, who's a Senior Managing Director and Director of Equity Trading at Raymond James Associates. And Dan's been keeping a close watch on the oil sector. But, before we get to that, I do want to ask about the broad market because we haven't seen a lot of reaction in U.S. stocks as this situation in Egypt's been unfolding. We do have a rally today. Stocks did change direction when he stepped down. So, what role is all of this playing?
Overall, the reaction has been fairly benign. On day one, back on the 28th and 31st, you saw crude spike 10%. It's subsequently given back all those gains, not in one fell swoop, but over the past couple weeks. On that Friday, we saw the market come off 2%. Some have argued that they used Egypt just as an excuse to take some profits here. It does point to an underlying dynamic that any pullback in this market has shown had a bit of a bid to it. But more importantly, the market's rallied 4% off that lows, and it seems like it's really just kind of a non-event. Once the original concern was that this could be contagious and spread throughout the Middle East, and that's when you had people talking about crude getting to $120. And once it was realized that that was not likely the case, then calmer heads prevailed, and it's been I don't want to call it a non-event, but less than focus.
Well, and Adam has been talking in recent days about some analysts coming out and saying if you really look at the supply situation with oil, it should be, say, $10 lower than it is anyway, and this perhaps temporarily obscured that supply dynamic.
Well, there was absolutely the concern that Middle East oil flows could be halted or at least disrupted, but I think people have realized that the Egyptian economy is tremendously dependent on energy, and so any government is going to be overseas investor interested, and particularly as it relates to energy, the Egyptian General Petroleum Council gets essentially puts up no capital and on average receives somewhere in the neighborhood of 50% of their revenues from outside E&P companies. So, in terms of stocks like Apache, where there was a very significant direct correlation to Egyptian exposure, it had a fairly significant reaction on day one, and then again, calmer heads prevailed.
Now, what about the concern or the hope, depending on who you talk to, that this is going to spread to other countries in the Middle East, perhaps those that have more significant oil production, for example? Does it make sense at this point to even take that long of a view?
I think it does, because anytime you've got a population that is young, connected, there's no shortage of cell phones in the Middle East, underemployed and earning wages somewhere in the neighborhood of $2 to $4 a day, and now we're in a global marketplace in a global world where they're no longer isolated, and it's only human nature to expect people to want a freedom and posterity, and so there could be those that look at this and say, hey, they pulled this off in Egypt, what are we doing here? So there is always that possibility, but you need to have the groundswell or at least some type of catalyst, and since it hasn't happened yet, it's the likelihood of that is somewhat mitigated.
So what do you do with oil stocks here?
We at Raymond James favor those, particularly the oil exposure in the energy space. We like coal, but that's not necessarily relevant to this story. We prefer to stay away from the natural gas type plays, but we've got our price target somewhere in the neighborhood of $100 for 11, and so we are bullish on the oil sector at this point.
And what about the overall market at these levels? While I've got you here, I got to ask you about that. This sort of melt-up phenomenon that we've been talking about that hasn't had a lot of volume behind it, but just seems to be sort of going up inexorably over the past several weeks.
Not unlike the economy, which is kind of, the recovery seems to be in motion, perhaps not as robust as many would like or had hoped. So you've just seen the absent a catalyst, markets will tend to bubble up or drift higher over time. It's all about earnings. 90% of investing is earnings, is from our perspective, and the earnings season was solid, if not spectacular. So, and then what you found was any number of investors who were perhaps on the sidelines. There was trillions of dollars waiting to be put to work, and perhaps they hadn't necessarily believed in the rally, and now are all of a sudden getting a little bit fearful that wow, we're halfway through the quarter, and we've got a lot of cash that we need to get put to work. So you're seeing that.
Just quickly though, in about 10 seconds, are we fragile at these levels now?
We are advising people to exercise just a little bit of caution in hopes of, or not hopes, but in preparation for a potential pullback.
Okay, thank you so much for coming in, Dan. It's great to see you. Daniel McMahon of Raymond James coming in to talk to us, Director of Equity Trading there.